All right, guys, now we are going to dive into the taxes on different stock options. Now, we've talked about how these options work in the past. We've alluded to how they're taxed. I'm going to go through this really quick as a refresher and talk through how they are taxed and what to look out for. This can be pretty confusing. And so I want to make sure that it's very clear and concise, but also that you get the full amount of information that you need. Okay, let's start with restricted stock units, RSUs. These are commonly given as part of a compensation package. And so you receive these, and it's usually, you receive a grant of a certain amount of shares vested over a certain amount of time. And from time to time, there are dates when you vest a certain number of shares. With RSUs, there's nothing special about the tax treatment of these. It's just important to know how they're taxed, okay? Different options actually do have qualified tax situations that are more beneficial. RSUs don't. It's just important to know. So you are taxed on the value of these shares as you vest. So let's say you have 1,000 shares vesting every quarter, for a number of years. The date that you receive those shares, the 1,000 shares, the fair market value at that time is considered income to you that year, regular income. And so, if you receive 1,000 shares per quarter, add those up, you got 4,000 shares vested that calendar year, that tax year. And depending on the fair market value of the stock upon vesting date, then that is going to be added to your total income and you will be taxed. Now, if you're working at a non-public company, these are shares that you can't sell typically or very easily at the very least. Okay, so you can't sell them to pay the taxes. You just know that there is a tax bill and you have to pay it out of your other income. Okay, out of your salary or cash bonus. So that's important to understand. It's taxed upon vesting. You don't pay anything for these shares. So they are just truly granted to you, the full value. You don't have to exercise, you don't have to buy in or anything like that. They're just given to you and the full amount is taxable to you as income. The stock value, so with all of these private companies, if they have stock plans, stock options and plans and things like that, they get company valuations done at least annually. And so people are like, well, it's not trading on the stock market. It's not a public company. So does it have a share price? Well, yeah, it has a share price. The company needs to be valued. It goes through a rigorous process to get a valuation on the company. And per share, there is a fair market value per share. Usually when it's private, it's only updated once a year. If your company goes through a big funding round that increases the valuation, then obviously the fair market value of that stock is going to change significantly. So that could affect the timing or the taxation to you on the shares that vest, okay? Now, sometimes the company can put in a double trigger provision within this plan, okay, within the stock option agreement, where two things must happen for you to actually fully receive the shares and be taxed on them, okay? So it is a little bit of a way to incentivize you to stick around even longer. Even once they vest and you receive them, right? Typically, you can leave the company, you still own those shares. Well, in this case, you have to vest and meet another requirement, which is a liquidation event, to actually fully vest and own the shares. And then and only then are you taxed. So typically, it's a vesting date and liquidation event like an IPO or an acquisition. Okay, so you might vest. So you vested the shares, but you haven't truly received them. So they're not taxable to you until it also meets the other requirement, which is IPO or acquisition, right? A liquidation event that's specified in there. Then, according to the IRS, you own the shares, and then you will be taxed on the full value of all of your vested shares up to that point. Okay, so that's really important to know. If you have a double trigger in your plan and you have a ton of shares vested, and then you're going to go public, you could have several $100,000 worth of options or more, right? In the seven figures vesting in one tax year. Okay, that requires you got to focus on tax planning if you think there's an IPO coming from the company and you have a double trigger. Okay, so that is for RSUs. I'm going to wrap up this video here and do the next one on incentive stock options. So stay tuned for that.
RSUs are powerful, but the taxes matter.